Hello, clients and friends. This is Billy Doughty from Doughty Financial, and it's my pleasure to welcome you to our first quarter economic review. At our firm, we partner with clients and believe an educated client is our best client. While we will always try our best to help you, when it comes to your finances, we believe that knowledge is power. One of our missions is to share with clients any knowledge that can better help them make an informed decision. What a whirlwind first quarter. Just when a sense of normalcy seemed to be realized during the first quarter of 2022, the world was thrown another hardship as Russia invaded Ukraine. For investors, this added more fuel for market volatility. Coupled with inflation and rising interest rates, the first 3 months of 2022 were a roller coaster ride for equity markets, which had their worst period since the start of the pandemic in the first quarter of 2020. Volatility is a great word to describe the first quarter of 2022. After several significant drops, at the end of the quarter, equity markets began to rally. For March, the S&P rose more than 3%, while the Dow rose 2.2%. Despite that upward move, they did not reach the same values they were at the beginning of the quarter. U.S. stock markets closed their first losing quarter since March of 2020. The S&P 500 closed down 4.9% and the Dow closed down 4.6%. Inflation is currently at a 40-year high. In February, inflation rose to approximately 7.9% from 12 months earlier. Although there is no established formal inflation target, the Federal Reserve generally believes that an approximately 2% rate of inflation is acceptable. As you can see from the chart, inflation has blazed upward the past 2 years. Inflation is a decrease in the purchasing power of money, reflected in general increase in the price of goods and services in an economy. Today, the prices for most consumer goods are significantly higher than they were just a few years ago. It's virtually impossible to avoid being affected by this inflationary pressure somewhere in your daily life. Whether it is at the gas pump or the grocery store, consumers are feeling the squeeze and are looking for ways to cut costs and spending in their daily lives. The much anticipated rise in interest rates came in March as the Federal Reserve raised the Fed funds rate for the first time since 2018. The benchmark federal funds rate was increased by a quarter percentage point to rest between 0.25 and 0.5%. Bonds and interest rates move in the opposite direction. When interest rates rise, existing bond prices tend to fall, and conversely, when interest rates decline, existing bond prices tend to rise. Recent times have not been very beneficial for bond holders. Bonds are many times considered to be more stable than equities for investors. This quarter, however, volatility in the bond market was high, and U.S. bonds had their worst quarter in over 40 years. Short and midterm bond yields increased this quarter. As the quarter closed, the 10-year Treasury yield was 2.35%. This is a significant jump from the 1.5% yield that 10-year bondholders had at the end of 2021. As interest rates rise, new bond yields are likely to change. Investors are expecting short-term yields to reach 3% in 2023. This is a good time for any bond investors to review their holdings. If you'd like to explore any exposure you have to bonds and whether they are still a good fit for your personal goals, please contact us. We are monitoring how the Fed's movements and rising interest rates are affecting bond yields. Safety comes with a cost. Have you seen what interest rates banks are currently offering to savers? According to Barron's, the average bank money market rates on April 3, 2022 were 0.33%. And the average 12-month CD rate was 0.2%. For many investors, today's ultra-low rates might not help them reach their goals. Therefore, equity should be considered for a part of a diversified portfolio. As we continue to the second quarter of 2022, many factors could complicate equity market performance, so investors need to be prepared. Equity market volatility is still very present. We stand by our mantra of proceed with caution. What are investors looking at in the upcoming quarter? watch out for more interest rate hikes. If you're planning on buying a house or car, borrowing will become more costly. There are many variables that could affect the speed and direction of the economy, including Russia's war on Ukraine and COVID-19. Savers may need to become more disciplined and focused. As your financial professional, we are keeping track of any changes that could affect your personal situation. Now, here's some things we feel would be beneficial to do in light of rising interest rates. Review all your income-producing investments. Lock in your mortgage rates or consider refinancing to get a better rate if you haven't already done so. Maintain liquidity for all near-term needs. Reevaluate and confirm your cash flow needs. And lastly, sometime this year, conduct a full review of your financial plan with us. During this review, we can look at risk management, how well diversified your plan is, and revisit your time horizons to make sure all these items are still compatible with your goals. There's currently a lot of noise that can distract an investor. Equity market volatility, interest rate increases, inflation, global unrest, and pandemics have all given the media, analysts, and economists much to talk about. Recently, two words that have been widely used are stagflation, which is high inflation, high unemployment, and slow or no economic growth, and recession is recognized as 2 consecutive quarters of economic decline. However, irrespective of what is presented, it is wise not to try predicting the future, but instead focus on your long-term goals and objectives. Having a solid investment strategy is an integral part of a well-devised, holistic financial plan. Staying disciplined and following that strategy during times of volatility is equally important. As your financial professional, we are here to help you pursue your financial goals. If you'd like to revisit your financial plan or discuss any concerns or ideas, please call our office or bring them up at your next scheduled meeting. As a quick recap, here are some key points. Equity markets still experiencing volatility, which is part of the investment experience. Interest rates are on the rise and expected to be increased faster than originally anticipated. Inflation is at an all-time high. There are many factors that could affect the direction of the economy and markets. Caution should still be the principal notion for investors. Stay the course. And as always, call us with any questions or concerns. We appreciate our clients. As a client benefit, you can add names to our distribution list to receive newsletters and presentations. We hope you will take advantage of this and add 2 names or more to our list. One of our goals for 2022 is to continue to help others. Some of our best clients were referred to us by existing clients. So please feel comfortable letting us know the names of anyone who you feel could benefit from our services or information. Again, one of our primary goals is to keep clients informed, and we appreciate you watching our update. Please call if you have any questions.